fluctuations. I mean, real estate syndications are still exposed to market fluctuations and economic conditions, both property values as well as interest rates.
You're listening to Alternative Investor Mastermind, where we do a deep dive on alternative investment opportunities and the lifestyle it can create. Join Jack Krupe as he presents actionable tips and tricks in doing passive real estate away from mainstream strategies. Go beyond the usual fix and flips and try less explored yet rewarding investing ventures, from multifamily properties, mobile homes to cryptocurrencies. Do not miss this opportunity to escape traditional assets and finally create wealth without Wall Street. Now your host, Jack.
Hey everybody, today we're going to talk about the pros and cons of being a landlord versus investing in syndications. And you should definitely listen to this episode if you are a burnt out landlord, a tired landlord that wants to be a retired landlord. If you're happy as a landlord, but you've got some properties that you've used all your depreciation up and are looking for some additional tax benefits, if you want to slow down a little, maybe you don't want to really expand and or you don't like the pricing of new properties in your area, and or if you want to diversify a little bit. Maybe you've got a lot of properties in one mayarea. Maybe you're in the Northeast, or you're in a state that's starting to overregulate rental properties like California, and maybe looking to expand outside of the area. We're going to talk a lot about ways that syndications can help. And lastly, if you're a do-it-yourselfer and you have fear or concerns about not being in full control, we'll talk a little bit about the syndication business and why at scale it's a different world. So being involved in a syndication of, say, a 200-unit building, it's a different level of professionalism on these teams that you'd be working with. So it's a little different than, say, turning over your properties to some local property manager or some realtor that is maybe doesn't have the sophistication to run the business like you could. Because personally, I found that our partners on our syndication investments are doing a better job than I would. They have that skill set, just a great operational, detail-oriented team. So it's why I focus more on partnering with really successful, larger, sophisticated operating groups rather than try to do everything myself. So, pros of syndications. Number one is the ability to diversify outside of your area, outside of your region in many cases. Real estate syndications provide an opportunity to diversify your investment portfolio. You're pooling funds with other investors, and it allows you to access a wider range of properties across different markets, different sectors, and different asset classes. And the more diversified you are, the lower the risk. So personally, and through the JCAM funds, we're invested in over 40 deals. That's across the southeastern United States, as well as the Sun Belt, Texas, Phoenix, Vegas. So then a smattering of deals in the Midwest as well. We're in a deal in Dayton, Ohio. We're in a deal in Indianapolis as well. And one of the best reasons to do these syndication deals is the professional management. It's a different world when you're going into a 200-unit building than buying a random single-family house or just buying a property that you may want to Airbnb. And at size and scale, over 100 units, as an example, you have on-site management. There's a leasing office, there's a full-time person there, there's a full-time maintenance person. So really can make the management a lot smoother when you have full-time staff at the property, as opposed to if you own 5 or 10 rentals yourself. You might get that 2 a.m. phone call, or the dealing with it on a vacation where there's something going on and you're trying to project manage something. Just having that larger infrastructure and that scalability is really powerful. Passive income. When I got into real estate in my early 20s, I got into it for passive income, quickly built up a portfolio of, within 5 years, had almost 50 units personally, and it absolutely wasn't passive. Single family and small, onesie twosies are very difficult to scale. And, I ended up putting in as many hours as my job in most cases. So, with these larger syndications, it is truly passive, at least once you've invested. I talk a lot about active passive income. The work is early on. It's educating yourself. It's listening to podcasts like this. It's going to conferences. It's having conversations with sponsors and fund managers. And that's where the work is. Once you're invested in a deal that you've vetted properly, at that point, it's really just monitoring the cash flow, monitoring the reports, checking in occasionally, but largely the checks come in, and you're ultimately, the other active thing you need to do is monitor your tax situation. As properties are coming up on their life cycle to potentially sell, you need to make sure that you know where your tax basis is, so that when it sells profitably, you can make the decision on how and where to reinvest to make sure you don't have to pay a large capital gains tax bill. Scalability is the main pro on syndications versus individual units. I've already talked about this, in some of the earlier points. But again, as someone who's owned 50 units plus personally, the ability to partner and be involved in these larger complexes, 100, 200, 300 unit buildings, it's very powerful. And you have less roofs to deal with when you have a 300 unit building than, say, 300 individual units. And it's just overall way more scalable. As far as risk mitigation goes, again, being diversified is very helpful. Being able to be in multiple deals with multiple partners. The way syndications are structured, a majority of the incentive is on the back end for syndicators, so that's also a big help. And most deals will pay a preferred return as well. So the way it works is, first you need to get paid a return on your money that may be 5, 6, 7, 8% annually on your actual capital. And then your capital needs to be returned. And then that's when the syndicator or the operator typically gets a percentage of the profits. So the incentives are aligned to, for them to run the deal as profitable as possible to, unlock those incentives. So what are the cons of syndication investing? First is, you are giving up control. For those that are concerned about that. So you are generally investing as a limited partner, and so you're not going to be involved in day-to-day decisions. The syndication, the sponsor, the management team, the operator kind of use those terms interchangeably. They're making key decisions, including the property, the financing, the property management, the operational strategies, the value add, which is the key component of many deals. So that doesn't suit everyone. I mean, certain investors just really like to be hands-on. With that said, there are some very top-tier sponsors that just are bordering on private equity funds or that do a really, really good job in this space. So, I think even those that really don't like giving up control, I think there are groups that if you dive in and see how good their operations are, it should make sense. One last point on the control: the more money you're investing, the more ability you may have to influence or control. If you're writing a check for $500,000 to $1 million, you can buy yourself a seat at the table. If it's a business you're looking at pursuing full-time in the future and you want to eventually become a sponsor, you don't just snap your fingers and jump in and do that, like you can with a single family house. So coming in as a as a limited partner can be a gateway to learn the business and get involved in the business, and eventually you can become a co-GP, and in the future you might become a GP, general partner, and lead your own deals. The second con is the lower liquidity. If you have a single family property, you can list it for sale and generally sell it in 90 days. If you own a stock or a REIT, and again, for accredited investors, I think REITs are often a poor tax investment, just because of the tax treatment. I've talked about that in a number of episodes. You can look at our episodes on taxes, and we've got a lot of content on that. But syndications are not an immediately liquid investment. You're going to be in from 1 to 10 years, and often 3 to 5 years is a typical investment. So you want to use capital that's longer term capital that you're not going to need to withdraw. Third con is fees and expenses. Syndications do have fees. There's typically is an acquisition fee. There are asset management fees, and there are property management fees, and then there's the incentive fees. The carried interest, as I've alluded to, the percentage of the profits that's paid out after all money is returned to investors. So those that are fee conscious, those that follow the whole Vanguard lower fees, it is what it is. I will say though that syndications and private real estate funds are vastly different than the stock market. When you're dealing with a more efficient market like the stock market, being fee conscious makes all the sense in the world. However, when dealing with syndications and private funds, it's more like investing in a business or a private business with profit margins. So, and that's how these opportunities have largely outperformed the stock market in over time, because they are not as liquid, they're not as publicly available, and that justifies some of the higher fees, just because it's frankly a lot more work, and it's a lot more work than just managing an index fund in the stock market. So I think the fees are very justifiable, and as you start investing, you'll learn what's typical as well. As long as the fees are market for what syndications generally are, then I think they're more than fair, and the operating partners need to have enough money in fee income to keep their lights on and to execute on the business plan and deliver those returns. Market dependency and fluctuations. I mean, real estate syndications are still exposed to market fluctuations and economic conditions, both property values as well as interest rates. So, unlike REITs, where sometimes the REIT stock value gets taken down just because the overall stock market's dropping, I think real estate, part of the benefit of not having that immediate liquidity is it's not the type of situation where you're going to panic sell and sell at the bottom. You're in for 3 to 5 years, and you're relying on a professional team to try to manage the ultimate sale and exit at the appropriate time. But when you have situations like last year where interest rates have risen dramatically, it does affects cash flow if you're in a variable rate loan, and it potentially affects exit timing. If you're in a fixed rate loan with 7 or 10 year debt, there's no reason to sell right now. You're printing monthly cash flow because rents have increased, inflation has increased, but the mortgage payment has stayed the same. And it doesn't make sense to sell unless you can sell and let someone assume your lower interest rate loan, which actually then may increase the value of the property and give you some upside. So overall, real estate is not completely independent from the capital markets. I will remind you, however, though, that the headlines you see about residential real estate do not always mean the same for multifamily real estate. For example, the residential, interest rates going up make it less affordable to buy a single family house, which means there's more renters. So, and then if the office market collapses, as an example, that doesn't really impact, I don't see that impacting multifamily that much. office is crashing because people are working from home and less people are going into the office. So, although it's market dependent, you need to be very careful parsing the data that you're receiving, because it's not always as clear cut as as it may seem when you see a headline. So that's about it for today. Please follow us on all social media: jcaminvestments.com, Alternative Investor Mastermind, LinkedIn, Facebook, Instagram, our YouTube channel. Please like and subscribe. And if you like what you're listening to, please leave us a review on your platform of choice. Thanks again. We'll see you on the next episode.
That's all for this episode of Alternative Investor Mastermind. Now that you know the many alternative opportunities out there all up for the taking, you can finally become ultra connected and ultra wealthy. Get more valuable advice from the experts by subscribing to the show at alternativeinvestormastermind.com. Become a winner in the world of passive investing today in alternative investment strategies. Thank you for joining us. Until next time.